Investing isn't just about passive income. It's about building serious long-term wealth. But here's the problem. The biggest buying opportunities happen when the market is down and most investors panic instead of taking advantage. It's funny how everyone rushes to buy stocks when they're expensive, but when great companies go into liquidation, people hesitate. Right now, there are 3 great opportunities in ETFs that can generate you an income every month, and few people are talking about. The idea of annual dividends may seem convenient, but the reality is quite different. What's even worse is relying on 1 or 2 stocks, hoping that the dividend payments will arrive without any unforeseen problems. The logic is simple. The more companies you invest in, the more stable your investments will be, and that's what ETFs are for. If a company decides to cut dividends or something unexpected happens, you could end up in a very uncomfortable situation. Now, imagine if you could receive passive income every month without worrying about the performance of a single stock or waiting for the dividend quarter. In this video, I'll show you 3 ETFs that generate you a monthly income and which are not yet in the market spotlight. ETFs, or index funds, offer a way of gaining exposure to a basket of stocks, which naturally reduces risk. This means that you can receive constant and predictable payouts without depending on the fortunes of a limited number of companies. This is a game changer for anyone who wants to ensure that passive income really does cover monthly expenses without the complications. The first ETF on our list is the WisdomTree US High Dividend Fund, or DHS. This is one of the most reliable ETFs when it comes to paying consistent monthly dividends, and the reason for this lies in its investment strategy focused on companies in essential sectors. We're talking about sectors such as energy, telecommunications, and healthcare, the ones you probably can't live without. You may not realize it, but telecom companies like AT&T or energy giants like Chevron are behind your daily needs, and this is directly reflected in your investment portfolio. DHS invests in consolidated companies that have a long history of paying stable dividends, which guarantees a certain protection against economic crises. This means that in a scenario of market volatility, you won't have to worry so much about payments. These essential sectors tend to be more resilient, even when the economy isn't doing so well. For example, companies like Philip Morris, Johnson & Johnson, and PepsiCo are some of the main holdings in this ETF, which guarantee a combination of security and stability over time. But what really makes DHS interesting is its yield. We're talking about an annual dividend rate of approximately 3.5%, which, although not an aggressive yield, is totally adequate for those looking for a constant and predictable cash flow. Compared to other investment alternatives, the DHS offers a return that is difficult to find in riskier options, not to mention the advantage of being paid monthly. This predictability factor is crucial for those who need reliable passive income without the surprises typical of more volatile stocks. In addition, the risk profile of the DHS is very conservative, which makes it ideal for investors who prioritize security. If you're the type who prefers to guarantee a stable return each month without worrying about big fluctuations, this ETF is for you. Its strategy of investing in large, consolidated companies in essential sectors without relying on high-risk stocks makes it a smart option for those who want to start diversifying their portfolio with a focus on security. Remember that this video is not an investment recommendation, just my analysis based on my opinion. Always look for a qualified professional. The second ETF on our list is the Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD. And yes, this ETF is actually known to many, but I think it's still an incredible opportunity. This is the perfect ETF for those looking for the ideal combination of security and monthly income. As its name suggests, SPHD invests in 50 S&P 500 stocks with high dividends, but with the advantage of being less volatile. This is especially important for investors looking for stability, i.e., a steady passive income without worrying about big fluctuations in share prices. The great thing about SPHD is precisely this low-risk, high-dividend approach. Unlike other ETFs, which may include riskier and more volatile stocks, SPHD chooses S&P 500 companies with a history of high dividends and a low volatility index. This means that while you are receiving monthly dividends, the value of your portfolio tends to be more stable, which is excellent for those who have a more conservative profile and don't want to see large fluctuations in the value of their assets. Among SPHD's main holdings are companies such as Verizon, Pfizer, and Realty Income Corp., all of which have a solid track record of paying dividends and share price stability. This ETF is a reflection of how actively managing a portfolio can result in a more predictable return. Verizon, for example, one of the largest telecommunications operators in the United States, has a solid customer base and a steady cash flow, which ensures that it continues to pay consistent dividends. Pfizer, for its part, is already known for being a pharmaceutical giant with a long track record of solid dividends, and Realty Income Corp is a REIT, real estate investment trust company, which is another excellent source of passive income, since this sector tends to have predictable and stable profitability. SPHD's yield is approximately 3.3% per year, which is a little lower than DHS's. But, on the other hand, the volatility is much lower, which can be attractive for investors who don't want to take too much risk. The management fee is also quite reasonable, which contributes to an interesting cost-benefit ratio. Best of all, this ETF also pays monthly dividends, meaning you can count on a regular cash flow without the typical worries of short-term volatility. So if you're looking for a more conservative strategy, but still want to guarantee a good return with monthly dividends, SPHD is an excellent choice. Now let's move on to the third ETF on our list, the Schwab US Dividend Equity ETF, or SCHD. This is the perfect ETF for those who wish not only to receive monthly dividends, but also to seek a combination of capital growth and stable profitability. SCHD invests in the 100 best dividend-paying companies in the United States, with a focus on companies with good financial health and a strong track record of consistent payments. What makes this ETF so interesting is precisely the combination of dividend payments and the potential for the shares to appreciate over time. With an annual yield of approximately 3.5%, SCHD is similar to DHS but offers something more: growth. Over the last 5 years, SCHD has appreciated by 43%, which demonstrates its potential for appreciation. This means that, as well as receiving consistent dividends, the value of your investment has a real chance of growing over time, providing a double advantage. You are not only earning regular passive income, but also increasing your capital with the appreciation of the shares. Some of SCHD's top holdings include companies such as Coca-Cola, Cisco, BlackRock, and Home Depot. These are widely known and respected companies with a history of financial strength and an ongoing commitment to dividend distribution. For example, Coca-Cola has been one of the largest dividend payers in the market, with a strong global presence, which guarantees a robust and sustainable cash flow. Cisco, one of the largest providers of networking and cybersecurity solutions, has a solid business model with constant revenue generation. BlackRock, for its part, is a giant in the financial sector and has exceptional asset management, which translates into good returns for its investors. And Home Depot, the largest chain of building materials stores in the United States, is an interesting choice for those seeking exposure to the real estate and retail sectors, both of which have good potential for generating dividends. The yield of 3.5% per year, combined with growth of 43% over 5 years, makes SCHD an excellent choice for investors who want to balance income and appreciation. SCHD's management fee is just 0.06% per year, which means that most of the return goes to investors. And of course, like the other ETFs on this list, SCHD also pays monthly dividends, guaranteeing that steady flow of cash that many investors are looking for. This ETF is ideal for those who want more than just stability. With SCHD, you have the possibility of combining stable passive income with capital appreciation over time. If you're looking for a balance between security, growth, and monthly dividends, this is the ETF for you. So you've got these 3 ETFs now in your hands. What should you do? Diversifying is the key to protecting your portfolio and increasing the chances of achieving your financial goals. Why not just choose one ETF? The answer is simple. Each of these ETFs has unique characteristics that meet different needs. The DHS, for example, offers greater protection against economic crises. On the other hand, SPHD brings a more conservative approach, focusing on low volatility stocks, and SCHD, with its combination of growth and dividends, is ideal for those looking for a more robust return and have a moderate appetite for risk. If your goal is to focus on passive income without worrying so much about capital growth, a good strategy would be to allocate 50% of your portfolio to DHS, 30% to SPHD, and 20% to SCHD. On the other side, if your objective is to focus more on growth than on passive income, you could make an allocation of 50% in SCHD, 30% in SPHD, and 20% in DHS. SCHD would be the central pillar of your portfolio, offering a combination of stock appreciation and consistent dividends, while SPHD would continue to guarantee stability. The DHS, with its protection against crises, would be given less weight in this type of strategy. Now, if your focus is more on stability, an interesting strategy would be to allocate 40% of the portfolio to the DHS, 40% to the SPHD, and 20% to the SCHD. This maximizes the security and predictability of dividends while still allowing you to enjoy some growth with SCHD. If you want to start living off dividends in 2025, click on the video on your screen now, but first subscribe and leave a comment if you watch the video to the end. See you later. Good investments!